you have your permanent life policy. Again, let's use that example of a mill, and you've been paying X amount into the cash value, and now say the cash value is worth 50 G's, right? And maybe this is year 7 or year 8, let's just say. You can then borrow against that 50 G's to do something, right?
Exactly.
But at the same time, you don't have to pay that 50 G's back. But what will happen is you will pay it back somehow, some way, if they have to pay out that term, they have to pay out that policy to someone because whatever happened. They take out that 50K and be like, yeah, it was a mill, but he took out 50K, so it's now 950.
If you're a business owner, you may or may not already have your online presence created. There are some mistakes that can be made, and I don't want you to be making them when you're starting your business online. One of them is not knowing when to get your hosting. Think of your website as a building, and your hosting is the land that your building is on. It's wise, and it makes a lot more sense for you to make your website around the same time as when you get your hosting. There is no advantage to you getting your hosting, say, in January, but then you start your website in December. That time in between you're paying for, and you have to renew your hosting the year after. Another thing is this: if you already have your online presence, one mistake is you could be making is not actually collecting your leads via your website. This is not the same as general inquiries. A lead is me raising my hand and saying, I'm interested in your particular service. A general inquiry could be something like me asking you, hey, what year did you start your business? The two are not the same. So I've put together an easily digestible checklist of the 5 biggest mistakes you could make online and how to avoid them. It's called the Secret Web Design Checklist. Also, I've got a book, and it's called Starting Your Online Business the Right Way. Just go to oyemade.com/performance. That's oyemade.com/performance. And you see the options for the Secret Web Design Checklist and the book to starting your online business the right way. Hope you enjoy those. Now, let's get back to the episode.
Talking about life insurance, we're about to talk about some strategies, some asset builder strategies. So yeah, basically, well, go ahead and start off and tell us, like, who are you, what do you do, and who do you serve?
Yes, sir. No, I definitely appreciate the invite. And who I am Maker Bia. I am a financial educator, really from the realms of life insurance all the way to investment. But my focus is life insurance because it's what people have no clue about what it is, how to really utilize it in your financial house, and the different options that's is in it. And most people are only aware of what came out in like years and years ago. And again, they don't know the benefit and even the downfall. Some people have it and don't even understand if it's working for them or not. So
Gotcha.
As a company, we really educate individuals specifically on what they have and what they need to have in their financial portfolio.
And a couple questions I'm going to ask you today, because I know there's someone in here who actually, she has life insurance for, but I think she's got group insurance, so it's from her employer. And I was saying to her yesterday, I said, I'm going to be talking to Micah today, and I'm going to be asking him some questions. And I said, I'm sure in the fine print, you need to double check that you still get that life insurance after you leave the company, because I feel it's only whilst you're with that company, and it may not necessarily be the best. So I know she has a question of, should she go and get her own life insurance separately from what the company is is offering her. But yeah, those are just some of the things I wanted to talk about today. I want to talk about what Donnie said about using it to make himself a bank. That one I definitely want to
Yeah,
know. I want to know about that
yeah,
because I even posted it on my stories because yo, when Donnie was talking about that, I was like, yo, this is interesting. I did not know about this. But
yeah,
let's start
yeah.
off with what is life insurance? What are the types of life insurance? And why do we need life insurance?
Beautiful question. Beautiful question. Honestly, what life insurance is your responsibility. Bottom line, understanding your responsibility, right? And we like to tell people when we're young and starting out our life, we definitely need to understand what our responsibility is and understand that if life happens at any point, making sure that or stopping us from getting our goals done, money needs to be involved, right? And when we're starting our life, we don't really have the money to be able to get to our goals, take care of the family, get the house, the cars, things of that nature. So life insurance comes into play to be if you're stopped in that process or that pursuit of your dream. You're telling these company, okay, you can take over for my responsibility now because I wasn't able to take care of it, right?
Yeah.
So life insurance is put in place just in case you're not able to reach your goal, right? So whatever is you think your goal of your business or you're worth $1 million, half a million, whatever it is, right? So what you do is you put in that coverage for yourself. So if life was to happen again, whether it's
Hmm.
your death prematurely or if you get sick, all of these things happen naturally to good or bad people, right?
Yeah.
So we need to, put things in place for our responsibility, right? Cover our responsibility, right?
Okay.
So really, essentially, what life insurance is taking care of your responsibility when you cannot financially do it yourself.
Gotcha. So life insurance is the ability to still meet your financial obligations when you might be in a position through no necessary fault of your own that puts you in a position where you might not be able to reach those or
Correct.
take care of those responsibilities normally as you were doing it previously. Okay.
Absolutely.
So
Absolutely.
this now brings me to my next question. What are the different types of life insurances? And then let's talk about life insurance as an individual, a business owner, and then life insurance that you may get as an employee. And then what are the
No,
benefits and disadvantages?
yeah, no, that's a good question. There are, as I mentioned, there are really two types. You
Hmm.
got the permanent and you got the temporary, right?
Okay.
On the temporary side, you have some that's like the group insurance, right? When you're with a job or organization, they cover you, and you don't have to qualify for that. Just because you're with them, with that company, you just qualify, right? You qualify.
Yeah.
You're part of the team. You get a jersey, right?
Gotcha.
you just
Gotcha.
you
You
part
get a
of it.
ring
So
regardless.
exactly, you get a ring regardless. Exactly.
Gotcha.
And the thing is, it's a beautiful thing because at least, first the company is covering its responsibility also if they lose you out of that company, right?
Hmm.
And they also are able to fund to the family if something was to happen to the employee. Be like, whether it's 20, whatever the amount is, they'll give it to the employee family if they lose their employee. And now you got term outside of those group insurance. It could be a 20, 30, 35, even 10 up to 15, like from 10 to about 35-year contract, right? Which is
Gotcha.
temporary. Okay. With that saying, you could get a 10-year contract, and that means within the 10 year, you're covered for your responsibility. If something was to happen within that 10 years, money will come to your family to take care of your responsibility within that time.
Okay.
Or if there's another one that actually recently came out, maybe within the last 20, 30 years, called terminal living benefit. Now, the difference between the original term and term with living benefit is while you are alive and you experience, unfortunately, a situation like having diagnosed with critical illness, chronic illness, terminal illness,
Yeah.
you get covered within that contract, right? So
Okay.
insurance company is able to actually fund you up to 90% of the death benefit early.
Okay.
So you're not being a burden to whether your family is or, creating these GoFundMe because you're not able to take care of what happened now, right?
Yeah.
Whether
Yeah.
it's cancer or whatsoever, you're not able to. So that is the new term, living with living benefit, right? It came up recently, but insurance as a whole has been around for decades on decades. I mean, you go back biblical time,
Yeah.
okay? And the how it usually works is you have to die for you to benefit from it.
Yeah.
Okay, and like I said, it's been switching up. So that's really on term aspect. Like I said, the only way you used to benefit from it if you die. Now, if you don't die and the contract is over, let's say you got a 10-year contract.
Yeah.
Contract
But
is
wait,
over. You had it.
just before you go into, so what we're saying now is with the term, which is one of the
Mhm,
types. The term is
mhm.
basically it can be 10 years, 30 years, 40 years, right?
No,
But
it could
basically
be
for
10
me,
years.
yeah, go
The
on.
maximum the maximum term is about 35 years.
The maximum
The
term is about
maximum.
35 years. So
Correct.
basically what I am saying is within 35 years,
Mhm.
hopefully nothing happens to me,
Right.
right? So after
Mhm.
35 years, if I've been paying, I've been healthy, I ain't smoking, I ain't drinking, I'm just chilling, very chilled lifestyle, nothing wild and
Right.
whatever. And my
Right.
health is just on the same level in the next 35 years. All the money that I've been paying to that term, what happens to it?
Well, it goes to the insurance company. It stays with them. It's kind of like renting. It's kind of like if you renting an apartment or whatsoever the case is. Um, when you leave, when their contract is up, do you go to the landlord and be like, "I know I was here for like 20 years. Can I get half of that rent I pay you?" You can't really
Gotcha.
do that because the purpose of it is you are asking this company to cover your responsibility just in case. At the same time, doesn't mean you just drop the ball and relax and they're going to take care of your responsibility. You're still living your life. You're still, putting away money. You're still taking care of your responsibility, right? But essentially, the money that you're putting into this policy, um, the contract is up, the money
Yo, Manka, your Wi-Fi is a little spicy again.
Yo, what is up with this?
Yeah, hello?
Yeah,
Can you
yeah,
hear
yeah.
me? Yeah,
Yeah, I
your
hear you.
Wi-Fi got a little spicy.
Come on. What's going on?
Technical difficulties, folks, but we'll
Yeah, I
be
know,
back.
right?
We'll be back.
Yeah, we'll be
Just working
back.
it out. Instagram doesn't want you guys to know this information. That's why.
Hey, man.
Yeah,
My
I think that's a
headphones
bit
going
better.
in and out. Is it?
Yeah, it's a
Okay.
little bit better now.
It's coming up, yeah. Okay. And my
Yeah.
headphones going in and out too. Okay.
Hello?
Yeah, we good?
Yeah, we're good. Awesome.
We're good.
All right.
Shot.
So
Oh,
yeah,
I've just seen my cousin. He's just said what up to me. What up, Koye? You good? I say what up to my
awesome. So
peeps.
yeah,
So yeah, you were saying so you go back, you've been paying that rent. There's no way I can go to the landlord and be like, yo, I've been paying this life insurance for X amount of time, let
right.
me get some bread.
Let
So
me get
that's not
some
what's
bread.
happening. So please continue, sir.
No. Yeah, yeah, yeah. So you can't go back and say, let me get some of that back. It doesn't work that way. In the meantime, if within that contract, if something was to happen, they ended up losing because they'll have to cough up whatever they promised.
Hmm.
The contract that you and them put together is Within this time frame, if anything was to happen to me, y'all take care of my responsibility. But if nothing happened to me, I am essentially the money that I put it in. I'm giving it to y'all.
Right. So basically, I'm kind of like, so
Mhm.
basically, I'm kind of like betting on a term that something happens to me.
Absolutely. Yeah. On a term, you bet you tell an insurance company either something bad going to happen to me within the next 10, 15, 20, or 25 years, or I'm going to die within 10, 20, 35 years. And once I do, X amount goes to the family or whoever you choose. It could even be a charity that you
So
choose as
why?
a beneficiary.
So why would I want to do a term if I want to live as long as possible, as healthy as
Right.
possible? So why would I go for a
Right.
term?
Beautiful question. Well, first of all, if you can't afford a house, right? If you can't
Hmm.
afford a house, do you not still need a roof over your head?
You do?
Right, you do. So, in the meantime, that since you can't really take care of your responsibility, if life was to happen today, right?
Hmm.
If God forbid you were diagnosed with X, Y, and Z,
Hmm.
if you can't fund it, you what now? There's a new thing is we go out and crowdfund, GoFund me, and
Yeah.
but that's not what everybody want to do. People got pride. People want to be able to take care of their own responsibility.
Yeah.
So implementing something just in case if any unfortunate event was to happen is always a great thing. So the purpose is you don't want to really necessarily always need insurance.
Hmm.
Okay, you don't want to really necessarily need insurance, but you want it for a time basic, right? So that's why most people who get the term is like, right now, unfortunately, I can't take care of it all for myself, and if life was to happen, I'll be stuck. So let me
Gotcha.
get this contract for 20 years. Within 20 years, if I don't die, my responsibility, I'll be able to comfortably take care of myself. I will have
Okay.
that X amount of money in my saving or in my investment to take care of me if life was to happen.
Gotcha. I see. So basically,
So
a term is kind of, it's not necessarily I expect to get something out of it. It is just just in case something happens, then
absolutely,
I've got something saved away to help with
right,
that scenario. Gotcha. Okay.
absolutely, absolutely.
Okay.
So it's definitely not it's never a bad thing to put in a just in case because it's never a bad thing. But
Right.
it's not something that you obviously are relying to get something out of it. No
Yeah.
term.
Okay.
And
Okay.
being that up to 98% of term is never really pay out because most of the contract goes away and people are still living. So the purpose of it is understanding why you got it in the first place. Most people have it and they think, oh yeah, I got insurance, right? And come to find out that their contract has already been expired and the person that sat down with them haven't really reached out to them and either try to get them to renew it and they're still paying
Gotcha.
these companies. So it's really good to always review what you have, where your money is going to. But yeah,
Gotcha.
very good
Gotcha.
question.
All right, because we had this thing in law which was kind of like it was called, I think it was someone who has a fiduciary duty towards you. I don't know,
Hmm.
does that apply in life insurance or in the insurance game?
No, so essentially that would be considered your people that you put as beneficiary. Somebody that has a tie.
Spicy again?
A call was coming in, but
No worries,
can
man.
you hear me?
Yeah, we can hear you.
Okay. Okay. No, somebody that has a monetary responsibility, you owe them something. Monetary responsibility essentially tied to you. They have money tied to you. So if you were to get a life insurance, or if you was to, let's say, something was to happen to you, their responsibility is still out there. right? So once they could actually get life insurance on you because they have some type of monetary value on you,
Hmm.
or vice versa. So if you're going in business with somebody, for instance, you could
Yeah,
actually, get insurance on each other if something was to happen to one or the other. At least your side could be handled or their side could be taken care of as well. Does that
gotcha.
make sense?
Okay. Yeah, that makes sense. Now, going back to that question which I asked about fiduciary duty, the reason why I was asking that is this. I know when you're speaking to, say, like an investment banker or your investment advisor, if they have a fiduciary duty towards you, they're not just trying to sell you a product or service for their commission. Because of that fiduciary duty, they have to sell you what's best, well, in
Hmm.
quotes, what's best for you and customized
Hmm.
to you. Whereas if they don't
Hmm.
have that fiduciary duty,
Mm,
they're just trying to get
that's
a
a good.
commission.
Gotcha, gotcha. No, that's good. That's a good question.
So
That
do life
does it
insurance
happen?
brokers or
Does it
advisors have that as
happen?
well?
That's a. It would depend because you got brokers. You got brokers out there that really have great salesmen, right? And
Yeah,
salesmen really who are out there that are just trying to make a buck. And at the end of the day, there is not written, in stone to have that legal rights for the insurance company that I'm not
right.
aware of. But with my company and what we do, we are brokers, so we're not necessarily pushing one product, right?
Gotcha,
We represent over 300 companies. So it is our mission really is to get the education out there. So we're not selling
gotcha.
specifically one company's product. So our mission solely to really get you educated. Once you are aware, fully aware, get your question answered. You choosing where you want to get.
Gotcha. Okay,
Yeah.
okay. All right. I guess then in that case, when we are speaking to whoever is talking to us, we should then ask them. So this is on us to ask them, okay, do you have a fiduciary duty towards me or not? If they say
Right.
yes, then I can kind of think, okay, maybe they will be trying to give me the best things that's for me. If they say
Right.
no, then I know most likely I'm a commission. So,
Right. Right.
all
Right.
right, cool.
Yeah.
Okay. All right, I get that out. I get that. So we talked about term. We talked about
Mhm.
mostly the benefits come from death. Are there any benefits from being alive under term?
Yeah, that's what I mentioned with the living benefit, which is the new type of life term insurance. It's called term with LB or term with living benefit, and
Right.
you
Okay.
you are living, but you're not living like the best life. You're in a
Gotcha.
chronic situation, a critical situation, a terminal situation, and with that, a company will be able to uh, give you up to 90% of what you apply for the death benefit. So
Gotcha.
to take care of that situation, the purpose is not to, bought off and just, go on trips and things like that. It's just to be
Gotcha.
able to take care of, the
Situations.
financial situation that you're going through. And once you do end up passing away, then the rest will go to the beneficiary.
Right. Okay. So now let me ask you this question because it's going to be tied into my second question. This is under term.
Mhm.
Do, is there a lowest level of the policy? Because the policy is what the whole thing is worth, right? So I could get a 35-year, um, because 35 years is the max, as you said. I could get a 35-year
Mhm.
policy, and it
Mhm.
could be, say, 100 grand, right?
Mhm. Mhm.
Now, is it do you get more paper the longer it is, or does it not matter? Like, could I get a 5-year policy? No, sorry, 10-year policy that is 100 grand on the term.
Great question. There is a formula to figure out definitely what amount of coverage that you need.
Gotcha.
Okay, because I mean, you got companies out there, or even online nowadays. People will, click one or two questions and figure out, oh yeah, you need $1 million policy or you need $100,000. And the thing is, people are walking around without the right amount of coverage, thinking, oh yeah, I got insurance, I'm good. But your responsibility is not fully taken care of because you didn't really go throughout the right method of getting the proper protection. And the formula for you getting the proper protection is called dying method. All right, which is D stand for debt, right? Where your debt is.
Uh-huh.
Okay. I stand for income. The purpose of really insurance is being able to replace your income. If you, especially if you are a person that's bringing in the income for your family, right?
Yeah.
Um, in calculation, it's been determined that a family really needs about a good 10 years to weed off a person that's bringing in the income, right? So your income yearly is multiplied by 10. Okay, so take care of your debt, your income, mortgage. If that's in effect, if that's not an issue, then that's you don't need to worry about that. And again, if you have responsibility of kids coming into the picture and you want them to go to school, things of that nature, or you yourself got a student loan debt, things of that nature. The education portion is in the E. So dime stands for debt, income, mortgage, and education, right?
Gotcha.
So now once you put in all those criteria and figure out what that number is, that's really when you know where your responsibility is financially to your family or your establishment or whatsoever.
Gotcha.
And then if you could afford to totally cover it, then you're like, okay, I could totally cover this in term or I could cover it in permanent.
Gotcha. Gotcha. Are you
Yeah.
in the airport? Because it sounds like the couple people behind us or behind you.
No, yeah, no, they're around me because I'm at the hospital. That's why I
All
can't.
right. I see. I
Yeah,
see.
yeah,
I
yeah,
see.
yeah.
Gotcha.
So I do apologize
No worries, man.
for
No
the
worries.
noise on the
All right.
background.
Cool. Yeah. No worries. Right. So, okay. So the DIE is the formula for them to. That is so negative. Die. Like.
No, 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 no. Dime, Dime,
Oh,
D
DIME.
I
Ah, right. Gotcha. Gotcha.
dime,
Dime.
dime,
Gotcha now. All right.
dime.
Okay. Ah, so that's where the
Yes,
mortgage. So the mortgage comes in under M. Right. Gotcha now. Gotcha
yes,
now.
and the
Okay.
E is the education. Yeah, 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 yeah.
Yeah.
So once you
Dime is
calculate that,
more positive.
right, 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 right.
Gotcha.
So yeah,
Okay. So the other question I was going to ask you, and I think this will now be, I think this is covered now by me understanding this dime is I can with the term insurance I can protect for loss of earnings and income, right?
hmm
Gotcha. Okay. So I could protect for the loss of earnings for whatever happens, whatever. And then obviously mortgage, education. Gotcha. Okay. Okay, cool. Okay. So is this the only version under the term side that is benefits whilst you're still alive?
yes, the term we're living benefit, correct? Term
That's
we're
the only
living
one.
benefit. Yeah, it's only two type of term. The term we're living benefit and the regular term, and it still works the same way. Or the group term, the group term is still a term. You like I said, you're covered while you're with a company, and the group term is not necessarily a bad thing. You could actually have a group term, and if you decide you leave the company or you get let go by the company, some company actually allow you to take it with you. Okay.
Gotcha.
Now, if you're able to take it with you, it becomes your own policy, and now you will have to go through the process of getting it covered on your situation, your health status, your age, and things of that nature, and it becomes more expensive at that time.
Gotcha. So
Most of the
so
time.
if I was under a group term policy, which is usually done by the company as an employee,
Right.
If my employer allows me to take it with me, I could take that further and then handle it myself.
Right. Yeah, they'll
Gotcha.
give you a time frame. Sometimes it might be like 30 days or so, but based on the contract, you'll know exactly what you're allowed to do within the time of you leaving the company.
Gotcha. And if I wanted to, like, say for instance, say I was employed now, and then after speaking to Manka, I'm like, yo, go speak to my boss. Hey, Manka said yesterday that I should find out about my term. Can I take it with me or not? And if they say no, I'd have to be able to negotiate. So if I'm valuable enough, I could negotiate that with them, I guess. Or is it something that's set in stone? Or is it just company
Well,
policy?
it's just company policy, and it depends on what kind of policy they have within that kind of company, right?
Gotcha.
And it's not a bad thing to be able to. I always recommend people get something outside anyway of
Yeah,
the company, even if you have something within the company. That's always just a bonus to, and always have something outside for yourself.
gotcha. Yeah, so have the company one as a bonus, but then have your own outside for yourself that you've actually done your own research and you're in control of. All right, yeah.
Absolutely,
Ownership and control.
absolutely.
That's all that
Yep,
matters in this game. All right,
yep.
cool. So we talked about term. We talked about the various tiers under term. We've talked about how initially it used to be benefit upon death, but now we've also
Hmm.
got some which are benefit upon living as well. All right, cool.
Correct.
Now, wait 1 second. I've got a question here from the person.
Yeah.
If the employer allows you to take the policy, or if the insurance company allows you to take the policy, yeah. So I'm just going to answer yes, Tony. He did say that you can. So he said you should have your one with your employer as your bonus, but you should have your own, which you control and you own for yourself. We're literally just discussing that. So you have your one which your employer is hooked up for you, and then you have your own which you go sort out yourself. At the same time, you can speak to your employer and ask them if you can take yours with you if it's set up like that. But it depends on if your employer is cool to that level or their company policy allows for that to happen. So that's kind of dependent on the employer, not so much your control. So, good question,
Yeah.
Antonia. Good question.
Yes. Good question.
Let's see if we've got any other questions up in here before we move. Okay, cool. So we talked about term.
Hmm.
Now let's go to, I guess we're about to talk about whole life insurance now.
All right. Okay. And I always like to correct people when I hear the word whole life, because
Okay,
it's permanent life. Okay. The
permanent
correction
life.
is permanent life, because
Gotcha.
permanent life covers the option of life insurance that you could actually have permanently, right? And within that contract, you have the whole life, which was the first ever permanent life that came out, and it came out back in like 1970 or so, right?
Right.
And when it came out, you was actually now allowed to save money inside of the insurance contract. And how it really works is, let's say you went through the process of figuring out where your dime is, right? Where your responsibility is to your family. And you're like, oh man, if God forbid something was to happen right now and I'm not having income X, Y, and Z, or I pass away prematurely, my family needs at least $500,000 to take care of responsibility without me. Okay, so now the $500,000 is your coverage, right? That's your coverage. And based on, your health rating at the time, the insurance company say, um, you'll be paying $250 a month, right?
Okay.
$250 a month for this policy. Now, on the permanent side, how it works is the $250 premium that go into this $500,000 policy, all of it doesn't go to just the cost of it. Okay, that money is split up, not equally. Again,
Hmm.
within the contract, you will read most what part of that money goes to cost. So let's say hypothetically with this 250 that's going to the insurance company, 100 or 150 of it is going to just the cost. Okay.
Okay.
Now that leaves you with $100 each month that will go into what they call cash value account.
Okay.
Okay, with a cash value account, that's where you're able to again save from with whole life. The equity that grow is between about 2 to about 3. Sometimes you might see 4%, right?
Okay.
And also depending on the company that has it, they also could add equity. I mean, they could add a dividend to it.
Okay.
So with dividend included, you might even see like 6 or 7% interest on a whole life policy.
Right. So what you're saying now, just at this juncture, is I could be paying
Hmm.
250 as my premium. Out of that 250, 150 could be going to cost, but a
Hmm.
hundred from that 250 could be
Hmm.
going to the cash value account, which essentially sounds like a savings account.
Absolutely. Yeah.
Gotcha. And I could be growing equity on 2 to 4%, possibly
Hmm.
also having a dividend, which is obviously an extra bonus.
Exactly.
I see. Interesting.
Hmm.
Interesting. Okay. Okay. Tell
Yeah.
me more.
And
Spill the gems to me.
yes. He's like, I want it all. No, that's good. So that's the basic of it. So whole life is set up that way, and when it came out, whole life is structured to be a fixed death benefit and fixed system. Meaning, let's say if right now, let's say you're going to pay the 250 a
Hmm.
month. That's what you're going to be paying until either you pass away or you reach 100 years old.
Right.
Okay, for whole life. Okay, you got companies that might be like, oh, you could only pay for 20 years and stop paying, or you could pay for 30 years and stop paying. But the thing is, once you do that, the coverage still need to get paid. So where the fund or the fee come from, it comes from the money that's supposed to be in the cash value. Okay,
Ah, I
so
see.
the cash value would now be able to cover the cost until again you reach 100 years old.
Right. So what you say now is this. So I could have a fixed system of, say, it's 30 years,
Mhm.
right,
Yeah,
for the
yeah,
policy.
you could do that.
Okay.
Yeah.
And if I hit the 30 years, they could say, all right, you don't need to pay anymore. But
Hmm.
what's going to happen is I've still got that coverage. But the reason why I still got
Right.
that coverage is because all the money that I've got saved in my cash value
Cash
account
value.
is now paying. So as soon as that finishes, then my coverage then totally ends, I'm guessing. Gotcha.
Exactly.
So
Exactly.
basically, it makes sense
So
to just keep paying, because really what they're trying to say is like when you go to a store and they say, yeah, we could do a refund, but we're going to give you a credit note,
right, right, exactly.
because basically that credit note really isn't, they're not really giving you anything. They're just saying, well, we already got this money, just spend the same money within. Gotcha.
Right,
I
right.
see. I
But
see.
but while you are alive and taking care, making payments, or even um, whether you're not making payments or making payments, right? If you see money inside of the cash value account, you are allowed to actually withdraw, not withdraw, from a whole life.
Or
You're actually allowed to borrow, take a loan from it. You're allowed to do so, right? And because it is your money. The
gotcha.
thing is, with you not putting it, and you don't have to put it back. Okay, you don't have to put it back. What happens if without putting it back, and if you do pass away, what it do is take that amount that you took out from the death benefit.
I
They
see.
subtract that. They subtract that amount from the death benefit. So essentially, just like you said, either way you have to pay it back, right? Because either you pay it back by you putting it back, or they pay it back by taking it from the death benefit.
They're gonna deduct it.
So, yeah, they're going to deduct it. So now, where the the cash value come into place for the whole life is because when it came out, whole life is one of the expensive policy because of the fixed the way it's set up, right?
Hmm.
So and as I mentioned, the cash value is supposed to fund the policy later on if you stop paying. Um, so when uh, anyway, with all insurance, it goes up. The fee goes up the older you get, right? With all
Yeah.
insurance. Okay, so whole life being expensive, the let's say again the 250 doesn't equal enough the older you get. So again, most of the money would be coming from the cash value to cover your policy. So if you borrow from it, right, that deplete the amount that's supposed to be in there to cover your policy.
Yeah. Gotcha.
Yeah.
Okay. So now here's my question. So my let's just say the whole life policy is
Hmm.
$1 million, right?
Hmm.
So whole life policy is $1 million, and it is for what's the maximum? You said is it until you're 100 years old? Is there a fixed term,
You,
or
you
is it just
could
100 years old?
no, it would be calculated to 121 if you want.
Right. Okay. So I could, in theory, do it forever, as in as long as I'm alive. In
It's
theory.
essentially yes, yeah.
Okay, cool. So I'm paying 250 towards that whole, or let's say no, Peter is paying 250 towards his whole life, which is 100 mil, right?
Hmm.
Now, Peter is, let's say Peter is 30, and Peter then, he's been paying this 250 to his 60. And then when he's 60, he passes away from natural causes, right? At that point, he's been paying 250 for 30 years, right?
Hmm.
So he's got some paper in his cash value, and he's got his
Hmm.
premium. So what
Hmm.
happens? Does Peter's family or whoever he's put as the beneficiary, do they get the 200 well, however much there's been in the cash value, as well as the 100 mil, oh sorry, as well as the 1 mil, or is
Hmm.
it, say the cash value is 500K, he gets 500K, and then they add 500K to make it a mil?
Mm, very good question. And essentially, that's a beautiful question. And being that we haven't gone over the rest of the other permanent policy, whole life,
Okay.
how it's structured, that's exactly how it works. What happens is they just give you a meal.
Mm-hmm.
Okay, so because that's what you apply for in the first place. If you didn't borrow anything from the cash value and you did end up having half a mil in there, the average person will assume the family is getting 1.5, right,
Gotcha.
delivered to the family, but not necessarily. That's not how it works. Okay, the insurance company will give you a mil. Okay, whether is they're taking that half a mil and adding another five to it, or they're coughing up $1 million. Either way, the money that you put in there is not being added to your policy.
I see. I see.
Okay, does that make sense?
I see. So then what then happens? So basically, if they give Peter a mil from his
Hmm.
policy, and there's
Yes.
still
Hmm.
500K in the cash value,
Cash value.
they keep the cash value, but
Yes.
whoever the beneficiary is going to take that mil. I see.
Yes.
I
Yes.
see. I see. I see. That's interesting. Okay. Okay.
Yeah.
And then the other thing which you said, which is also very important, is this. The older you get, the more expensive it becomes. So
Hmm.
really and truly, if you were going to go for a term policy, which the maximum
Hmm.
is 45 years,
35.
really, oh,
35. I like to
35,
emphasize.
35,
35.
35.
Yes.
Gotcha. Okay. So if the maximum is 35 years and you're going for a
Yeah.
term policy,
Yeah.
really, if you're going down the term route, you should be getting that from maybe, I'd say 35, if as in at age 35 is when you should be getting it if you kind of want to think maybe something could happen that you could benefit from it, i.e. you die before you're age 70. So if you get it at 35 and you're paying for it and you get the maximum term of 35, so that's 70 years left. You're going to be age 70 by the time it ends. If you, was it, the average lifespan is like 65/70, that based on the stats is the time you should get it technically. Would that be correct?
No, no, good question though. The thing is, when we talking about term or just permanent?
No, I'm
Yeah,
talking
and
about
honest,
terms. I'm going back to term now because I know term is 35 years, but I'm trying to
I
think
got some
if,
math.
yeah, I'm just trying to think of the math. Like if somebody wanted to go with term, but they were kind of
Mhm.
like, okay, let me try and get it as close to the possibility of me needing it. So either the person passes away or they get too old to work or whatever,
Mhm.
possibly from 35 onwards might be the better time to get it if they can't afford the permanent life.
Okay. So no, that's a good question because first of all, at the end of the day, we don't predict what's going to happen to us tomorrow.
Hmm.
We can't do that. And being
Yeah,
the fact that insurance gets expensive the older we get, you wait till 35, you don't know where your health status is, what anything has happened. Insurance is cheaper the healthier you are and the younger you are, right?
gotcha.
In the context of your responsibilities, obviously, you don't wait till you're in your 30s or whatsoever to have responsibility. You got people that
Yeah,
become parents in their teens,
sure.
right? So, or even have a home or student loans. Your responsibilities start when you start your life.
When you start getting
So you
responsibilities, yeah, true.
right. So you want to be able to cover your responsibility when you can cover it.
I see.
And again, it's a lot cheaper when you're younger.
Yeah, I heard that. I heard
And
that.
and in the beginning, as I mentioned, the purpose of having term insurance is not for you to really need term insurance. It's a buffer for you to be able to take care of your responsibility on your own when you get there,
Yeah,
right?
yeah, that's true.
So, if going back saying that term doesn't really pay out, and if you get it at a later age for longer, for let's say the 35 years, you'll be paying a lot into it, and you won't be able to get it. You won't be able to get any benefit out of it because, um, again, you're just trying to predict again when you're gonna die,
Yeah,
essentially,
yeah,
right? And nobody knows that. You can still get at 35 and reach 70 and 80, and
yeah,
that contract dies, right?
gotcha.
So always, always recommend get it as early as possible, whether it's the term or the permanent, okay? Because it's going to be much reasonably cost, okay? And you have term that you could convert. You could convert
Oh,
term
you
into
can convert.
permanent. You can
Okay,
convert term into permanent. So let's say
talk to me.
you have a 10 or 20 or even 30-year policy, right? At the moment, you can officially pay for a permanent policy, but you're able to at least pay for the term, and now you get to a stage in life that you could put in more money. You could convert your term into a permanent where you could actually build up some equity. That's what the cash value actually really is, the equity that you could either borrow from or withdraw depending on the type of contract it is.
Gotcha, gotcha, dude. I'm learning so much today that I didn't understand before. Right? Yeah. So
Uh,
actually, going back to what you said originally, that the purpose of term isn't for generational wealth. The purpose of term is a just in case buffer. That is true.
right.
Whereas permanent life, now that could more likely be generational wealth, lump sum payout. Um, And that is where you can turn yourself into a bank. So I think I now kind of understand what Donnie was talking about when she was saying you have your permanent life
Mm-hmm.
policy. Again, let's use that example of a mill, and
Mm-hmm.
you've been paying X amount into the cash value, and now say the cash value is worth 50 G's, right?
Mm-hmm.
And maybe
Mm-hmm.
this is year 7 or year 8, let's just say. You can then borrow against that 50 G's to do something, right?
Exactly.
But
Yeah.
by the same time, you don't have to pay that 50 G's back. But what will happen is you will pay it back somehow, some way, if they
Right.
have to pay out that term, they have to pay out that policy to
The
someone
policy. Right. Right.
because whatever happened. They
Right.
take out that 50K and be like, yeah, it was a mill, but he took out 50K, so it's now 950.
Right. Right. Right.
See,
So again,
see.
yeah, and again, that's the first permanent policy which we mentioned is the whole life. And in about 1980, they came out with what's called the universal life.
Okay,
Okay,
Universal
and
Life, talk to
universal
me.
life came out in 1980, and it's set up in the same way as how you fund it, and some of the money goes to the cause, and some goes to the saving, which is the cash value. The
Hmm.
difference with this is you got flexibility in the death benefit. It could actually increase or even decrease based on your situation, right?
So you mean the
Or
policy itself could increase? So it could go
yeah,
from a mill to something else.
exactly,
Okay,
exactly.
okay, talk to
Okay,
me.
and if life is happening and you can't really afford to completely pay, um, there are you could actually afford to miss one or two payments depending on how the contract is set up. Okay,
Okay,
versus how whole life was set up. It is really structured and rigid. If you miss a payment or two, you essentially are losing your policy. In this case, with universal life, it's not like that.
okay,
Okay, and the equity with universal life is between about 3 to about 6%. Okay, so it's a little bit more in the equity side or the interest that you get.
okay.
Okay,
And this is interest on the money that's in the
cash,
cash value.
absolutely, the cash value.
Gotcha,
Yes, yes.
gotcha, gotcha.
Okay,
O-
and yeah, so you have that flexibility in there with a universal life.
Okay, okay. I see.
Okay, and
And this is Universal Life. Is Universal Life, I'm assuming, tends to be more expensive than permanent life just because of the
okay.
benefits?
So whole life, universal
Yeah,
life. Um, the next two I'm going to mention are all considered permanent life insurance. Okay,
gotcha.
permanent life insurance would be the whole life, the universal life,
Universal Life.
the variable universal life, which I'm going to talk about, and the index universal life, which I'm going to talk about. Those are permanent life insurance.
Okay.
Okay, and yeah,
Okay. Talk spicy to me. Tell us, Micah. Teach me. I'm listening.
right, right. So yeah, that's essentially how it works, and it's not necessarily
All right, so whether you're a business owner providing a service or you're an e-commerce business with products, you know you need a website. The most common problems that I hear from business owners are they don't know where to start, or they're confused with all this person said this, that guru said that. It's all information overload, and it's forcing you to leave money on the table and not grow as quickly as you would like. Okay, let's bring some clarity to the situation. You're a business owner, which means your website is an asset that's meant to work for you round the clock, no lunch breaks. It should position you as the expert, attract the right type of customers, and have a system in place for those potential customers to book you for appointments, pay you for consultations and other services, as well as buy your products on your website. And even when someone doesn't pay you right there and then, it should have a follow-up system in place that allows you to collect that lead and then convert that lead later on down the line. And all of this needs to happen automatically in the background. Now, high performance businesses are the type of clients who tend to need these solutions, and they're the type of clients we already work with. So if you're in the 5-figure range, or you're already doing 6 to 7 figures, but you know you're not yet taking full advantage of the internet in the way that's right for your particular business, the solution is this. You need a high performance client attraction website for your high performance business. One that's custom made to work for you 24/7, whilst you focus on growing and scaling your business. So go to www.oyemadeit.com/performance, select the option for web design. Alternatively, you can go and click the link in the description, or there should be a link in my bio on Instagram. Remember, this is not for everyone. This is for businesses who are looking to level up, scale up their business, and stop leaving money on the table. We work with businesses that are a right fit and those that we believe we can help achieve their business and financial goals. So that's oyemadeit.com, oyemadeit.com/performance, or there should be a link in the description below, or there's the link in my bio on Instagram. We look forward to hearing from you and working with you. Now, let's get back to the episode.
Life per se, because you could, I guess, adjust it according to what's going on in your situation. It doesn't have to go. You don't have to pay it to 100 years like whole life. Most whole life, like I said, they're calculated so your policy can last to a whole life.
Gotcha. Okay.
So it could last to 100, I should say. So it could last to 100 years old. Right?
Okay.
But whole universal life is not necessarily calculated that way. And then in about 1990, out here in the States, stocks, I don't know how UK market was. 1990 stocks was doing amazing. Everything, mutual fund, was doing great. So
Yeah.
insurance company came out with the variable universal life, right? And with that, the person that's buying into it is taking the sole responsibility.
What does that mean?
Meaning if you bought this product and you choose what mutual fund that you want to invest your money in, because now it's not an actual account that your money goes into. If you're choosing, okay, I want to invest my money into this certain mutual fund or in that mutual fund. So your money actually goes into the market.
I see. So whereas before you was going into the cash value, this time it can go into the market.
Into the market, and now you're taking sole responsibility whatever happens to it. So there is no saving bucket that's waiting on you. If it goes up, it's all you. If it goes down, you taking all the hits too. There's no real concrete floor.
Gotcha. I see. So let me play out that scenario. So if I had the variable universal, would it not just be safer for me to put my whatever is, so some is going to go to the cost, and then something which would have usually gone to the savings account, the cash value account, I just say, put it in, what are they called when it's a compilation? Is it a mutual fund?
Mutual fund.
Yeah, so when it's a compilation of the best companies in that industry, so like NASDAQ, like the best tech companies.
The index,
is that what they call?
The index.
The index, yes. So would it just make sense for me to just put it in whatever the safest index is or the highest paying index?
Gotcha. As far as the variable universal life, with that, I don't have my series license for me to go deeper into a variable product. Okay. But on a high level, how it works is you choose a mutual fund that you want that difference to go into. You are investing your money into a, mutual fund, and based on how it's performing, you get the result of it.
Yeah, but I've got
Or
to know what mutual fund to go into. Yeah, so
exactly,
that's yeah. So now I get when you said it's on me.
right,
You take the
right,
responsibility. Yeah, I get that now.
absolutely,
Okay.
yeah,
Yeah, I heard. I think if I've got a lot of financial knowledge to know which funds I want to go into, then yes. I think that's primarily for people who know what they're talking about when it comes to the stocks
right,
and yeah. So
absolutely,
I probably need to speak
absolutely.
to the crypto queen about that one. I'll say, yo, Whitney, which ones do you think?
There you
You
go.
know,
And
so
then,
uh,
and lastly, and lastly,
index.
yes, in about the year 2000 or so, they came up with the
Hmm.
index universal life. Okay, and index universal life is honestly a mixture of the predecessors, in the sense, you have the cash value, and the cash value now is not really in the market. The cash
Yeah.
value is not in the market, but it's the reflection of the market. So meaning, depending on what's going on in the market, your account is accredited a certain percentage, right? Um, Depending on the company that you go with, they might have give you a percentage between, let's say, 0 to like 20%,
Hmm.
or they might give you from like 0.75% to 15. They Each company give you a floor, which means the lowest credit interest that your account could get, and the maximum crediting your account could get. Does that make sense?
Right.
Or do I need to go in a little detail?
No, I'm going to ask you some questions on that. So I've got the
Okay,
lowest
okay.
floor and I've got the
Mm-hmm,
maximum floor. Okay.
mm-hmm.
And you said this. So with the index universal, this is based on how the market itself is doing, not any particular
Right,
fund, not any particular index.
right. You
That's what you
got,
said.
yes. You have global. You have S&P as in the states. But yeah.
Okay, cool. So yeah, global and you got S&P. Okay, so let's say, because if we look at what happened in 2020, if
Mm-hmm,
I had an index universal and my
mm-hmm,
index universal started in March,
mm-hmm,
right? And then
mm-hmm,
COVID hit everybody and everything that
mm-hmm,
happened.
mm-hmm.
What we're saying is that my index would have gone super low. Oh, yeah, my whatever.
Yeah, yeah, yeah. No, great question. No, no, no. The thing is, so when I said the accrediting method that's given to the account is the company would say, um, based on the market performance, this is where we will be crediting your account. Meaning, um, again, if the market was tanking -50%, right,
Hmm.
your account would never go below zero, meaning the crediting method. Your account itself is not performing inside of the market, so your money is not fluctuating. The crediting method, meaning how much percentage that will be accredited to your account, is the one that will fluctuate between the zero or the
Hmm.
max, the lowest floor and the max. So, meaning, again, if the market was tanking, what a company would say is, we won't credit you anything right now. Your account will be frozen in a crediting method until the market start going up. So we could, if it start going up, if it went up 5%, we'll give you that 5%. If it goes up 10%, we'll give you 10. If it goes up 50%, the max we will give you in a certain scenario will be 20%.
Gotcha,
Does that make sense? Okay. So
gotcha, gotcha.
your money is not inside the market, so it goes up and down with the market. But the crediting method, how much they credit to it, is the one that is between the minimum and the maximum. And the
Gotcha.
minimum, depending on the company, It could be zero, or it could be 0.75, depending on a company that is out there offering it.
Gotcha. I understand that now. So let's just say the market was doing what the market is doing. I've got the
Right.
crediting method, which is basically instead of me having that cash value benefit, instead I have a crediting method. So I'm paying 250 every month. 150 is going to the cost, and then that 100, which normally would have gone into the cash value account, is now going to be um, used as the
Okay.
crediting. Is
Okay.
that
No. No.
correct?
Okay. Let's not. Okay. Your cash value is the one that is growing at this crediting method we're talking about. Meaning, that let's say that $100 we mentioned,
Gotcha. So that
the
still
hundred,
goes into the cash value.
now the growth of the cash value is dependent on the crediting. Okay,
Gotcha now.
so
Gotcha now.
why this is beneficial and good to understand is because in the scenario of the whole life, the credit that you get is between about 2 to maybe 3%, right? 3 to 4%, right? In this case, you could get up to about 10% on your account that's inside of cash value, or you can even get 20%, right? Growth on your money. And that rate is locked in on compound interest
Gotcha.
versus, your money will be able to grow faster the more credit you get, right? The more interest you get, essentially,
Yeah.
versus the less interest you get. So, yeah.
Gotcha now. So yeah, so it's the crediting on the cash value. So whereas before it was 2 to 4% on whole
Right.
life or 3 to 6 on universal, with this case, if they say, hey, the lowest is 0, but the highest is 20, I could be getting
Yeah.
that 20.
Yes.
Gotcha. Gotcha.
Yes.
Gotcha.
There you go.
Gotcha. 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 I understand it now.
And yeah, and really the money. So we understand that with whole life, we're going to borrow from our cash value. With universal life, we're going to borrow from our cash value. Um, with IUL, index universal life, we could borrow and we could take a withdrawal.
Wait. So say
Right?
that. So with universal, we can't
You
borrow.
you could borrow,
You can
and
borrow.
you could also withdraw as well. You have that ability of doing both. You could
Right. I
withdraw
see.
and you could yeah, take a
Okay.
loan
So
from it.
so all the other ones you could borrow, and
Yes.
obviously you either you pay it back yourself or they deduct it. Whereas with this
Hmm.
one, you can borrow and withdraw.
Yes.
I see.
Yes.
Interesting. So if I
And
withdrew, so let's say it was again, let's use 50 grand. I've got 50 grand in my cash value account, and I take out
mhm,
10 G's. So I've left 40 in there. So I don't need to put that 10 G's back. But
mhm.
then, so I've withdrawn that 10 G's. So then, does that then mean that 50 will still be 50, or what?
Good
Now, what
question.
happens in that scenario if I can withdraw
You
and borrow?
you withdraw how much? 40,
So yeah,
right?
no.
You
So
withdraw.
it was 50 in my cash value, and I took out 10
Hmm.
G's.
Hmm.
And
Now you
obviously, we
have
spoke
40 in there.
before. Yeah,
Right? You have 40 in there. So what happens is your account is now working off of 40, right? The crediting is based off of 40 because you subtracted that 10 out. There's nothing really in the negative side. It just deplete your account of that 10. You just depleted your account of that 10. Versus if you were to borrow, your account would be operating as if you still have that 50 in there. Meaning with a crediting system, your credit 20, or let's say 20% added to a 50 versus 20 added to a 40. Does that make
gotcha.
sense?
Gotcha,
Yeah.
gotcha, gotcha. So the benefit of borrowing is whatever interest you're getting with your equity and all of that, it works as if you haven't borrowed. But then
Exactly.
when the actual, say, payout happens, if you haven't put back what you borrowed, they deduct that anyways. I see. So
Exactly.
it's actually better to borrow and put it back as opposed to
There you go.
withdrawing. I
Right.
see. I see. Bruh, I've just had a full-on masterclass. I am glad we did this on the live because people would definitely benefit from this 1,000,000%. 1,000,000%.
Uh,
Now, this brings me to my next question. You don't have any peeps over here that you work with? You don't have any like providers over here, or do you?
no, none that I work with. There is a lady that I connected with recently, but she is more of a money manager
Right,
or
okay.
like a financial advisor, so to speak. I'm not sure if she has connection. Um, I didn't get a chance to reach out to her to get on this live. I wanted to. I would reach
Gotcha.
out to her and make that connection and see again, like you mentioned, you really want to sit down with people that have your best interests at heart,
Yeah,
right?
yeah,
People that are
100%.
not really going after the commission. Because if you really, honestly, I would say if you really have the mission at heart, the commission will come. But
Yeah,
most people look at commission more or less than really having the mission at heart. So that's the unfortunate part. But I would reach out to her because really, when I spoke with her a little bit, I definitely saw some really good value from her. So that's
yeah,
really the only connection that I have out there when it comes to in the finance industry.
yeah. I get that. But do you know the beautiful thing about this is now that I've spoken with you, like
Mhm.
my level of financial literacy in life insurance particularly has gone
Yeah,
up by 100%. So like
I
I
appreciate
know
that.
to ask these questions. I know to ask, okay,
Right.
cool. What is if I go with the variable, what are you giving me in terms of that? If I'm going with the index, what's my highest? What's my lowest? Can I increase my highest? Can I increase my lowest? Like I know to ask these questions. Whereas before, I would just have heard, oh yeah, we'll put it against the market, and you get whatever happens in the market. And I'll be like, oh, that
Right.
sounds dope. You know,
Right.
I wouldn't
Right.
know that
Right.
there'd be, but actually there's a lowest and there's a highest, and then if this happens, we have to freeze. I'm just thinking,
Mhm.
hey, whatever happens in the market, I'm going up. But
Right. Right.
it's these little things, these little nuances, these little bits of information that help you to get informed, so that when you start asking these questions, because like you said, life insurance is super important, and it is something which, depending on the usage that you want, can set you up and your family up if something
Absolutely.
happens to you. So, like you said,
Right.
it is a responsibility. You then
Mhm.
have to decide which one do you want to go with. Do you want to go with term or do you want to go with permanent? And then
Mhm.
the cheat code that you dropped in, you could take term and turn that into a permanent. Like, I didn't know
Mhm.
that. I did not know that. I
Right.
felt
Right.
like yo, you had to have one or the other. I didn't know
Exactly.
that you could take your term and then you can then turn it into a permanent, which then brings me to my
Mhm.
other question. If I wanted to have, say, all four of them, I could do that, right? It doesn't affect the next policy. So if I go with one company, I'm like, all right, cool. I want whole life for you. I want universal with you. I want variable with you, and I want index universal with you. It doesn't affect the other. Like then I'll be like, oh well, you hooked up with those guys first, so we're not gonna hook up with you.
No, you could have them
Obviously,
if you
if you've got
choose.
the paper to do it.
Exactly. The bottom line, if you got the paper, you could definitely do it. But once you understand how it works, you more or less you will want more of what you already have. For instance, if you understand how whole life works, and you're like, I'm getting a fix between 2 to 3%, and I would have to put in 100K or whatsoever for this money to be able to work for me. Versus you're like, I got an IUL, I'm able to get up to 20% on my money. Why not get multiple of that? Or if I understand, and I'm a risk taker in the sense of stocks, and I understand the stock game, things of that nature. Let
Yeah.
me
Why don't I
put more of
just
my
borrow?
money in there, right?
Yeah.
But you essentially you can get all of it if you choose to, or you could get more of what you
Yeah.
have. If that makes sense. And in the conversion side from term to permanent, how it works is, let's say if you have term with XYZ company, right? XYZ company has to have permanent policy for you to convert it to to convert to their
Right.
permanent policy. Okay. If XYZ doesn't have a permanent and you're trying to convert to another company, you're not converting. You that conversion ratio doesn't work in that sense. It has you
I
would have to
see.
convert into within the same house, essentially.
Gotcha.
If that makes sense.
Gotcha. Gotcha. So
Okay.
if I'm downstairs, I don't want to go upstairs. It's in the same house. I can't go upstairs in someone
Exactly.
else's house. I see. I see. Okay.
Exactly.
Another question, which thank you for actually giving me that nuance because I was thinking I could be with these guys and I could say, hey, I'm done with you guys. I'm gonna switch. But now that
Yeah.
you've made that clear, that's good.
Yeah.
Um, the
Yeah.
other question I was going to ask is this. So we talked about borrowing against your cash value account. Can you borrow
Hmm.
against your policy? So I've got a mail policy and I've got 50K in my cash value, but let's say what I want to buy is 100K.
Hmm. Can you
Can
borrow
I?
against your death benefit?
Yeah, can I
No.
borrow? You can't borrow against
You
that
can
benefit. You could
you
only borrow
can you
against
can your cash the value that's
cash
inside of
value.
your policy. Yeah, from your cash value, correct.
Gotcha. Gotcha. Okay,
And the
cool.
thing is, the beauty about utilizing your cash value is that it's tax shelter.
Yeah.
Okay, it's tax shelter, meaning the money is set up tax defer. Okay, let's make sure we understand that term. It's not
Yeah.
tax free when it's set up. It's tax deferred, meaning if let's say you set it up and 20 years later you like, oh, I built up 200K inside, and I want to be able
Yeah.
to take all this 200K. What happens is in the United States, we call it IRS.
Yeah.
Okay, the IRS now realize
Alphabet
that
boys.
yes, the alphabet boys. They're like, wait a minute, you pay 100,000 into an account, right? We saw you put that money in because we know what you had, and now all of a sudden you got an extra 200K. Where did that come
Mm,
from?
mm.
Okay, now we haven't had our portion of that yet, right? So now you have to be able to pay the tax on that if you got rid of your policy, right? If you got rid of your policy versus if you had that 200K inside of it 20 or 15 years later and you take it in increment, right? You take it in increment, you don't have to pay tax on any of your gain,
I see. So if I take
okay?
out a lump sum, which is like, is this like capital gains tax? So if I took
Exactly.
out a lump sum, so if I take out the whole 200K, they're like, yo,
Hmm.
we want a piece of that pie too. But if I take
Right.
out, say, 10K here, 10K here, 10K here, and then eventually it leads up to 200K because I've taken out 10K 20 times, I don't have
Right.
to pay on that. I
Exactly.
see.
You don't have to pay because, again, at the same time, um, essentially, if you decide to close out your account, meaning cancel the policy, and
Yeah.
you want to, take out the money that's in there, that's what happened. Versus you keep the policy in force and still take out the money in increments. You still have that shelter blocking, your gain.
I see. I see. So if I set it up in my cash value, I've got 200K, and let's just say I wanted to end it, it wouldn't make sense for me to take out the 200K at once. It would make sense that
Right.
for the next, maybe over the next 3 years, I take out 10K 20 times, and put that 10K 20 times somewhere else. Cool. And then come back and say, all right, cool, I've taken out my 200K. I don't want to deal with you guys no more. And then the alphabet boys ain't going to come after me. And I can chill, I can sleep at night. All right, I see.
Alphabet boys, I like
that. Yeah, because all of them are alphabet boys. They always got some alphabet in their names. It's never just one name. It's something, something, something. It's never just one name, you know?
Right.
So yeah, I hear that. I hear that. Yo, Mackin, this has been a masterclass. I really appreciate it, my man. I really appreciate it. So tell the people, what is the best way for them to get in touch with you if they wanted to holler at you?
No, man. Really, the ways to get in touch with me. First of all, my name is Maker on all social media. I do workshops. We do this live. You can reach out to me on IG, Facebook, whichever. Phone numbers on IG as well. Email me. But really, the mission is to really get the education out there. And what I haven't mentioned, which is really, 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 really critical in the financial building, is health aspect of our money. Health. Okay. Health is so critical in our financial building because, again, I don't know in the UK if there's an age requirement to retire. But in the United States, it used to be like 65, now it's moved up to like 67. And most people have to wait till those age because you have things like what we call Medicaid that the government is able to help you with some of your medical expenses when you retire at that certain age. But there is investment called long-term care, right? Long-term care that you're actually able to attach policy. The thing is, on the public,
Your Wi-Fi went out again. The last thing I heard properly was long-term care.
Why you get up? It's connected.
I don't know. I think it's the Wi-Fi in there. It just gets
Yeah, it's just stinking.
yeah.
But can you hear me?
Yeah, I can hear you now. Hello? Yeah, I can hear you. So the last thing I heard was long-term care, and then it just kind of went all fuzzy. It's still a little fuzzy, but we can hear you.
okay, long-term care is really critical tool that we could actually add to our investment on the life insurance aspect. We could get it separately, right? We could get it separately, and if God forbid, again, something was to happen, we could utilize it, or we could add it as a rider on our insurance. And honestly, you can't add it to the whole life. You can't add it to universal. You could only add it to index universal life. Okay, you can add it to index universal life, and how it works is, and this is one of the only way that you could utilize your death benefit while you are alive. Also, besides the living benefit aspect of it, living benefit. Let's say you have $1 million, as we've been talking about, $1 million policy. Depending on the company could be like, okay, because you qualify for living long-term, your death benefit.
Yourself. You're not able to clean yourself. You're not able to. You're not able to.
Make it. You went out again.
Jeez, what's going on here?
Yeah, you went out again. The last thing I heard was because you qualified for, and then it just went fuzzy. They don't want you to spill this game. That's what it is.
Stop for real, man.
They don't want you to spill the game.
All Okay, the headphone just acting up. Let me just see.
Yeah, take your time, man. We'll wait. We'll wait for this game. We
Can
will
you
wait for
hear me
this
now,
game.
though?
Yeah, I can hear you.
Okay,
Actually,
okay,
it's kind of a little bit better now.
okay, awesome. So yeah, with, long-term care being added to your permanent account or the IUL in this case, you're able
Yeah,
to actually utilize your death benefit while you're alive. Some company will give you even 4% of your death benefit. In this case, if you got $1 million and you qualify for long-term care, you getting 4% of $1 million each month to take care of you. Now you choose what type of lifestyle you're going through while you are again on these unfortunate event, right? So you could be at
see.
home, you could go to a facility, you could be, or you could even hire a family member to take care of you. Versus if you were in an unfortunate event before, most of the time
Yeah,
caregiver, which family taking care of you, usually some of them will have to leave their job, and now two income is lost, right? And
yeah.
you're not really getting out of your investment to take care of you. Now your cash value is intact, and you're using the death benefit to take care of you in long-term care situations. So we always educate people on the importance of long-term care, because it's not only for the elderly, okay? Because
Okay,
again, at all ages, at all stages, I should say. So long-term care could
gotcha.
be utilized for somebody as young as 18, somebody as young as 20, 30, up to however age.
But do they have to have had something happen to them before they can
Long
qualify for long-term care?
long-term care, yes, you're not able to do um, two of the five daily living activity. Let me,
Right.
as I mentioned, you're not able to move around yourself. You're not able to feed yourself, clothe yourself, transfer bodily fluid yourself, continent. So
Gotcha. Okay.
yeah,
Okay. I
that
see.
yeah, to utilize the death benefit while you're alive.
Gotcha. Okay.
And
That's
of course, we
interesting.
understand with cash value, once you get the money from the cash value, you literally could do with it whatever you want with it. You can utilize the cash value to start a business, to buy a car, to buy a house, to fund a kid's college education, whatever you deem with that money that you got from your cash value, you could do with it. So that's the beauty of also having utilizing your cash value.
Gotcha. So the other thing which I learned from this conversation is that it's probably better for me to have a cash value account more than a savings account.
Um, yes and no, because um, this is an investment,
Yeah.
right? And it would take time for it to grow into where you want it.
Yeah.
Versus
Definitely.
having a saving account is easily accessible.
Yeah. Yeah.
You can get
Anyone can
to it.
have it
You
without
could
any
get to it
cost.
right away. So what always the recommendation is have enough in your saving to cover your emergency fund. And now, if you have way more than that, everything, now you can deviate, right?
Gotcha.
Yes, but you don't want to just have this as a sole thing that you have, because if thing was to happen and you don't have enough in the cash value to borrow from, then you're still essentially stuck.
Yeah.
Or if
Gotcha.
yeah, and if it's not something that is critical, chronicle, or living long term care situation, then you again you're stuck. So yes, have something in a saving that's emergency fund,
Mhm.
okay, and invest.
And build up with with
Yes.
this, with
And build-ups. Yeah.
your life insurance.
Yes.
Okay,
Because yeah. Because again, this is an investment, right?
gotcha.
You got to understand investment. Yeah.
And say my premium was, let's use that example again of my Millie policy, and my
Yeah.
premium is 250 a month. If I
Mhm.
wanted to pay more than that, could I do that?
Absolutely. And so there are three ways that you could fund it. Okay. You could put in the bare minimum. Okay. So they will calculate when you going at illustrations, when you're looking at illustration,
Yeah,
you can see the, they'll show you the bare minimum that you could put into this account that will be able to make this policy last as long as it can.
yeah,
Okay. With that bare minimum. And secondly, they could show you an illustration that if you put in just enough so it could grow equity, which is in the
yeah.
cash value, it will show you that as well. And then it could show you if you were to max fund this account, how that would look like and how early you could access the money.
Gotcha. So basically, like, what's it called? I think it was a compound interest calculator. Is there something similar to that? Funnily enough, one of the girls, like a friend of mine who I was actually discussing this with, Rebecca, she literally just joined. Like me and her were talking
Okay.
about compound calculators, and she's literally just joined. Ain't that
Yes.
a sign? Ain't that a sign? So yeah, that makes sense. So basically, if I wanted to pay my premiums into my life insurance account, we could do the bare minimums. We could obviously do the max minimum, and then what was the one in between?
You could be doing, you could do enough for it to grow some cash value. You
Gotcha,
could, yeah,
gotcha.
you could put in
But
enough for
essentially,
it,
I could put however much I want to put into it. Essentially,
essentially.
so like
Yeah.
if it's 250 a month, and I say, you know, I've actually got 50 grand already, I could just put 50
Mhm.
grand in straight away.
You
Gotcha.
you could, so you could, there is ways that you could actually just make one payment to
Mm,
this account and have it for the entirety of the let's say if it was illustrated to 100, and they would show you an option of if you wanted to do that. It's not advised to do that because you don't really get the most out of that policy, meaning in the sense of the growth.
gotcha.
Because if let's say if you put in, they said a single premium is 50 grand, right? And you put in
Hmm.
that 50 grand, your money won't really grow. Your policy will last, right? But your money won't grow.
I see.
Okay. Versus if you, they show you, okay, you could put in the very minimum is $50, and but if you put in 150, it will grow like this. Or if you have a little bit more, you put in 300, this is how more it will grow. So depending on the policy that you get, you have the max you could put in. So the max for 250 might be like 2 grand a year, right? That you
Gotcha.
could put into it. And the max for a half a million might be like 4 grand a year. Does that make sense?
Yeah, yeah. I
So
heard that.
depending on the size of the policy, the maximum that you can put in goes up.
Yeah, I see.
Yeah.
I see. Cool, cool. Well, I think I've learned everything today that I needed to learn. I've asked every question I could think of possibly. Maker, it was an absolute honor, my man. Absolute honor. Like, yeah. I now know how to speak to people and advise people about um life insurance, and not advice because I'm not a financial advisor actually, but talk
Right.
to people about
Right.
life insurance policy and give them educated information, because if we're trying to grow generational wealth, we need to have the financial education to do that. And that's one of
Absolutely.
the things that unfortunately they don't teach us in school, but
Right.
a certain level of society they teach their kids and their bloodlines
Mm,
about it. So if we're aiming to be on that level, we got to be
Right.
doing similar activities. So
Absolutely. Absolutely.
yeah,
And I
this was
mean,
dope.
this been around, like I said, for decades on decades. And the thing is, we always, growing up, most people, families, teach them to put their money in the bank, right? And we're used to having our safety with the bank, but our money doesn't grow,
Yeah.
right? And the thing is, bank safety is insurance, right? Their safety is insurance,
Yep.
and they get their growth there too.
Yep.
They
We're
get their
using
growth
our money.
exactly, right? And we could do the same if we get ourselves educated. That's where the
Yes,
concept
sir.
of being your own bank come from,
Yes, sir.
right? If you educated enough, now you're like, okay, if I have my emergency fund in the bank, now let me go ahead and really build myself. And instead of and when I set up the right policy, 10, 15 years from now, I see that I could have 50, 80K in there. With that 80K, if it's starting a business, if it's borrowing from it to do whatever I need to do with it, now with you borrowing from it, there are fees on the withdrawal, right? I mean,
Mm-hmm.
with the
We're borrowing.
loan that you take, the
Yeah.
borrowing, but that loan goes back into your account. So essentially, you're charging yourself for the interest.
Gotcha.
The, okay,
Gotcha.
so
So if I
instead,
take out, yeah, go on.
right? So instead of you going to a bank or like a car to get a car loan, you take the money from yourself, go get a car, and you could pay yourself back, or you don't have to
Gotcha.
pay yourself back.
Oh, you don't have to
Versus
pay yourself
you took
back.
a car loan, if you took a car loan, you have to pay that back plus the
Yeah.
interest that's going back with it. You
Yeah.
understand? So these are the concepts that we need to really understand and understand well.
100%, my man. 100%. Yo, this is so dope. This is so dope. I love it. I love it. I love it. I feel like, how we're reading Limitless right now. I feel like I've upgraded one level now. Just from this conversation, I've upgraded one level.
Right.
Yo,
I
so
appreciate it.
dope,
I
man.
appreciate it.
Yeah, my man. Yo, dude, I will not keep you any longer. Thank you so much. If anyone wants to holler at my boy Maker, like he's got his Instagram in the title, so you get him up there. Click on his link in bio, takes you to his website. He's got his number there, his email and everything. Next thing I need to talk to him about is making sure his website is high performance and he's got his digital marketing set up.
There
But
we go. Yes.
we'll have that conversation another day, my man. We'll have that
Yes,
conversation
sir.
another day. Yo,
Yes, sir.
Maker, you have a great rest of your day and much appreciated, sir.
No problem. I appreciate you, man.
Appreciate you, my man. Take good
All
care.
right. All right. Bye.